welcome everyone to ABFI's Business Family Breakfast. It's part of our Family Enterprise Leadership Series, which is sponsored by Canadian Western Bank. And they've been a great partner of ours over the last 3 years as we've been putting on this program, offering webinars and breakfasts to the business family community. So before I hand things over to Marvin and the panel, just to do a couple quick introductions. So we're going to have Marvin Washington, who is the College Dean at the University of Alberta. He'll do a little bit more of an introduction shortly. And then we have Matt Evans, who's the President and CEO with CWB Wealth. And then we have Julie, who I really should have asked how to say her last name properly ahead of time.
Afanasiff.
Okay. I'm going to let you say that to everyone, too.
Sounds good.
And then Kelso, Brennan with 310 signs and high signs. So I will turn it over to you four. But thank you, everyone, for joining us this morning. I believe Marvin has the land acknowledgement ready to go, so we'll get going. Thank you, everyone.
Excellent. So good morning, everyone. And before we get started, I'd like to do a land acknowledgement. The University of Alberta, its buildings, lands, and research stations are primarily located on traditional territory of Cree, Blackfoot, Métis, Nakota Sioux, Iroquois, Dene, and Ojibwe, Saulteaux, Anishinaabe nations that are now known as part of Treaties 6, 7, and 8 in the homeland of the Métis. The University of Alberta respects the sovereignty, lands, histories, languages, knowledges, systems, and cultures of First Nations, Métis, and Inuit nations. So as Matt said, I'm Marvin Washington. I'm the College Dean for Social Sciences and Humanities. And some of you probably wondered, that's a long title, and what does that mean? And so what's interesting here, we're sort of involved in talking about family businesses and understanding what that looks like. The University of Alberta, in its wonderful wisdom, realized that no one person, the provost, could manage 17 faculty deans. The span of control is just too much. And so about 2021, they set up 3 college deans by provost. There's one in charge of health sciences, so medicine, pharmacy, dentistry. There's one in charge of college natural sciences, engineering sciences, and ALS. And then under me, my faculties are business, arts, law, and education. And so I'm happy to be here, and I'll be moderating the panel. And so I'll let them introduce themselves in this order. I'll first start with Matt Evans, CWB.
Thank you, Marvin. Matt Evans. I'm President and CEO of CWB Wealth, which comprises the wealth management operations of CWB Financial Group. So within our wealth management business, we supervise just over $10 billion of client assets. That includes about $8 billion of private client assets under management and administration, and about $2 billion of assets under advisement within our Indigenous Services channel. And we have offices across the country: Vancouver, Calgary, Edmonton, Toronto, and Montreal. And I've been with CWB for 14 years and in this role for about 4 years this January. So
Thanks.
Turn it over to Julie.
Perfect. Thank you. So I'm Julie Afanasiff, and I'm the managing partner of Sequeira Partners. So we are a client-focused boutique approach transaction advisory and valuation team based in Edmonton with offices in Calgary and Vancouver as well. So I've been working on, mainly helping entrepreneurs and other business owners sell, transition out of their businesses for the last 20 years. I think I've seen a few different scenarios, and I'm happy to be here and talk about them today.
Well,
thanks, Julie. My name is Kelso Brennan. I'm the founder of 310 Sign, which is an online regulatory and compliance-based sign company. We operate about 100 domain names, all in the regulatory signage space. And it was acquired in 2017 by High Signs here in Edmonton. So I still manage the company and a group of sign companies inside one roof at High Signs. So we've got 55,000 square feet of manufacturing space. And I'm excited to tell you about the story here today about how High Signs acquired my company.
Excellent. So thanks. And so we'll actually start there. Could you walk us through the timeline of your decision to sell 310 Signs to a family business, highlighting key milestones?
Sure. Thanks, Marv. I think the first thing was that I had planned to sell the business from inception. So maybe talk about that a little bit. I'd read a book, Amazon One Click. And so Amazon, sort of the whole premise there was Jeff Bezos starts an online bookstore but doesn't own any bookstores. And so I kind of grasped the concept thinking, what could I sell and do online that wasn't really done yet? And so I had a software development background, not so much in business. I kind of did that later in the MBA with Marv, actually. And I was looking for something that we could sell easily, where I kind of mentioned what you see is what you get. So historically low rates of return, because what you're buying is what you can see on the screen. So I came to a very familiar site here in Edmonton, a construction zone, and noticed all these traffic signs. And I thought this would be something that we could put online. So there's a standardization. I think that's the same thing with books, which was Amazon had the ISBN number. You've got the author, the page numbers. So it had data. And so I was looking for something that had data, and came across traffic signs, as well as other types of regulatory signs like Alberta Energy Regulator, well site signs and things like that. But we kind of set a goal of 5 years. So we would try to create a sales channel that we could clip onto another business. So this kind of factored into some of the decisions for ramping up key milestones and deciding when we would go to market to sell the business. And the intention always from day one was to be clipped onto a larger business. So I think part of selling it was a lot of preparation, like most startups. You're really ramping things up. We tried to bootstrap it, ended up taking an investment on from a Calgary-based investor who helped accelerate things. And when I think about selling it, maybe it was somewhat green, which, well, it definitely would have been. We started to engage some experts at that time, KPMG, and some just some strategic advice on valuations for what I call a bit of a hybrid model. Like, it's not a tech company per se, but it's tech helping traditional industry gain more traction and then sell to different markets in a bigger picture. And so we started to kind of ramp up. We tried to divest from it about 4 years in, and found it to be challenging when we were dealing with bigger organizations. Maybe we'll talk about that a little bit more, but ultimately, probably about a year in advance, really getting all of the books nice and clean, which of course we were doing along the way. Not trying to add assets where we didn't need to, so that it was making the purchase price more digestible. We'd lease a lot of our equipment instead of owning it all and having this big balance sheet of assets that maybe another company didn't necessarily want to take over. And so we, kind of set a 1 year milestone and key milestones, thinking about who could the key partners be, which ones would be strategic. Are these ones buying EBITDA, or are they buying a strategic play? And we easily, positioned ourselves to be clipped onto something else where we would shed all of our overhead expenses, and then sort of like shrink our company down in size, and then clip on this e-commerce platform onto an existing business. That's sort of a bit of a long-winded story about how we got there, but maybe I'll look for some follow-ups to that.
Excellent, thanks. So Matt, and then maybe Julie, from your perspective, what are some common or critical milestones in the business selling process?
So for us, Marvin, we work with a lot of business families as part of CWB Financial Group. CWB, if you don't know, is a bank fully focused on mid-market business owners. And so in our wealth management practice, the business families that we tend to see through CWB, they run the gamut. We like to start working with business families early and helping them plan for that eventual succession. And it's interesting listening to your story, Kelso, because you started you had a vision in mind of what that exit was going to look like. And then what you sort of did is cultivated a portfolio of options, right? And what are the real options for exit? That can include bringing other owners into the mix at a point in time, either like in a non-control position, and that can help you get to the stage that is kind of that ultimate exit. And then you've got options at that point, right? You've got strategic buyers, you've got financial buyers, you've got in family businesses, as many of the people in this room would well know, there are often options for a next generation of ownership within the family. So we try to be part of that conversation, helping business owners plan. And really for us, in the years preceding an exit, and it really is years in most cases for successful exits, right? You really do want to plan ahead. That would be my main theme, I think, for this morning is successful exits really result from several years of advanced planning. And our role in that is often to help the business owner and the business family navigate the blurry boundary between their business and personal finances along the way so that things kind of stay in an orderly kind of fashion along the way. And then as an exit gets nearer and nearer, or as the business owner's vision for exit starts to become clear in their own mind, we really function as part of the team of experts. Kelso, you talked about KPMG, and you really do need, your transaction advisor, your accounting, your legal, and in our case, financial planning, investment management. So, in terms of milestones and timelines, I guess my comment on that would be start early, start planning, even from day one, right? Yeah. Your exit is sort of part of your vision for the business. And there are many options for that. And then the milestones are really depend on the person, right? Depend on that vision they have for how they want to play out their business story.
Excellent.
Yeah, and I think, in terms of milestones, something that sounds like you did really well early on was understand the value of your business. What is it worth? And also, how are buyers going to see, and what lens are they going to take when looking at your business? So what are the enhancers that are going to enhance value of your business? What are some of the detractors? And if you can figure that out early on and really think about that critically, there's a lot of things within the business that you can do that are going to improve the worth and the value you're going to see from a buyer. So I think that's something, to Matt's point as well, we always encourage people to think about early on is, what's my business worth and how can I make it worth more? So I would say that's one critical milestone early on. I think one of the other critical milestones is when it comes to shareholders, really having that discussion and saying, if we're looking at a transaction down the road, what's important to us? What makes a good transaction? So is it, I want 100% out of the business to free myself to do something else? Is it I want to transition and have a partner that's going to help me take it to the next level? There's a lot of things that need to be considered. And sometimes we find that doesn't happen until it's too late. You've got somebody at the table and then you realize that, shareholders or family members that own pieces of the business maybe don't have the same vision in mind.
Excellent. So thanks. So I'd love to follow up on the question with you, Julie. Mm-hmm. So how do you think about the actual timeline to plan this? Mm-hmm. Typical timeline, best case scenario? Yeah.
It's a tricky question because, as Matt said, the longer you can plan for something, the better the transaction's likely to be, the better value you're going to get. The actual process itself, once you've engaged advisors and you're ready to go to market and you're starting to prep the business in terms of putting together materials and things like that, it's usually somewhere between 6 and 12 months to find that buyer, get through negotiations, diligence, all that sort of thing, and get a deal closed. But the upfront planning on it can happen years in advance. So we always prefer to work with our clients, 3-5 years outside of a transaction. The other thing that can change, whether it's on the 6-month end or on the 12-month end, is the type of process that you're undertaking. So, early on, as we're learning about our clients' objectives, one of the things that we talk about is within a transaction, there's typically 3 things that clients want to see. They want the highest price possible, they want it to be a confidential process, and they want it to be fast. And so understanding of those 3 things, what's the most important, can also guide what kind of process needs to be run and then how long it's going to take. For example, if confidentiality is very important and they're really worried about that, you're not going to want to take the business and talk to 50 parties about buying it. You're going to want to keep that narrower. But you may not get the highest price. So there's a little bit of trade-off, and I think it's really worth thinking about that up front, and all of that's going to affect the process.
Excellent, thanks. So Kelso, how does that sort of technical advice match your experience?
Yeah, just thinking back, the timelines certainly were that 12 to 6 month mark. You sort of expect things to move a little bit quicker, and I think early on we had some suitors that were board-driven organizations where the family decision makers weren't overly involved anymore. So that feedback loop when you supply information for the due diligence process tended to be 1.5 months from now, and then maybe too much deliberation happens at a boardroom table. and then you lose another 1.5 months. So I found that to be a bit of a slow process. So having your ducks in a row and all of that work in advance was so important. To your point, having a strong package and already having it prepared, that helped us. For the first time we had a deal fall through, where we were almost certain that it was going to come together, and I think myself and the team sort of took our eye off the prize, and so we were so confident that it was going to close that we kind of watched our focus deviate from the company, and sales started to slip a little bit. So one of the learning lessons when we ended up engaging with the Fath group here in Edmonton, which is Tom and Dave Fath, was when we had an initial letter of intent in place, it was pedal to the metal. Like we wanted to show them what value that they were getting. That was a really important part. And I think at the end, when we ended up actually divesting from the company, we ended up renegotiating at the very last minute because there was so much cash in the account, far more than we had expected in that sort of like 4 or 5 month period of time, which was, as a happy surprise that we ended up coming back and negotiating for half the cash in the account. Or we could have just said, well, we'll keep going because this is working. But I think it was just that intense focus to get to the end milestone and sticking to the plan.
Excellent, thanks. So, Matt, from your experience supporting Canadian businesses, how does wealth advisory play a role in this timeline?
Yeah, I think there go back to kind of Mike earlier comments where, for us it's really participating as a trusted advisor as part of that business owner's advisory team. And what I'll share is where we've seen very successful business transitions and exits. It really is where the business owner has cultivated depth in management, cultivated a real plan, as I said before. And then, where we get involved is really on the psychological side, on the counseling side, because there's an emotional journey here. And a business owner, you kind of touched on this a little bit, Kelso, like your priorities will change as you're going through this process, as you're getting nearer and nearer to an exit. I listened to a podcast with this individual named Brad Jacobs, who started a number of different businesses that he successfully scaled up into the billions-dollar level in value. And his most recent series of companies is in the transportation space. But he was talking about, he's done 500 acquisitions in his career, so he's bought a lot of businesses, often family businesses. And you kind of joke that there's 2 points in a person's life where they may temporarily go insane. One of those is when we're getting divorced. Another is when we're selling the business. So there's just a lot going on in a person's life emotionally, psychologically. So our role as advisors is on that frontier, helping the business owner and the business family navigate that change, what change there may be in relationships. If it's a family business and there's more than one member of the family involved, what is everybody's role on the other side of this? If there's family members who aren't involved in the business, what is their role as a transition is occurring? And so we really just try to help, manage expectations. One thing that you often find with business owners is they've created a lot of value in their business. They've created a lot of wealth through that business value. It's sometimes trapped in the business until a transaction occurs, but that's been a concentrated high-risk bet. And they've compounded the value of the business and their wealth through their shareholdings at a high rate. You're talking 15, 25, 40, 50, 100% a year. And they need to have their expectations calibrated out the other side of that for what's next. Are they going to want to go into another operating business where they're taking that same kind of concentrated risk and compounding at a high rate? Or do they want to take the proceeds of sale and sort of do some other things with it, pay off a mortgage, put some money away, and build up a more diversified portfolio of investments, which is going to compound not at 50% a year, it's going to compound prudently over time, but it's going to reflect the lower concentration risk and just the overall lower risk profile. So it's that side of the psychological and emotional experience, preceding a sale, coming through a sale, and then on the other side of it, where we kind of play our role.
I'm really loving this conversation between sort of like, again, the research nerd in me is just finding this exciting because we sort of have the lived experience, the sort of support structure, then sort of like the view of many different of these transactions. And so as I sort of continue the conversation, so when would you sort of typically advise or come into as a wealth advisor sort of these transactions? At what stage in the process? Early, I'm assuming, but so what would that look like in terms of coming in?
We tend to be in pretty early again, because the way that we love to work with business families is from an early stage. So again, the core work we do early on as the business is scaling up and getting to that sustainment, the growth phase is working with our partners in the bank to ensure that if this is a full relationship we've got with this client, that the business side of the financial life, the personal side of the financial life, and the boundary between them is well managed. And that is sort of the work of every day in a client relationship. And then, again, working with them as counselors to ensure that they are ready, their family is ready, and they've got everything sort of squared away before they get into that very intensive, 6, 12, 18-month experience of marketing business for sale, and or contemplating other forms of succession, right, to the next generation, to a management team, whatever it may be. So for us, we like to be in there early. Again, we're not, when it comes down to the actual deal, it's folks like Julie working directly with the business owner on the transaction, and we're making sure that we're thinking about things like tax, right? So, we got tax is often one of the main drivers for how a transaction is structured to proceed to sale or consideration, forms of consideration and kind of deal points. So we need to be in that conversation, ensuring that, the tax liabilities are planned for, everything has its bucket, right? And making sure that is all squared away. So there's peace of mind. And our role is kind of around holistic peace of mind.
So how does that match sort of, Kelso, sort of your consideration then?
I was sitting over here smiling, sort of reminiscing about this, the experience in 2016 and 2017, and then again in 2020. So we've sold, my wife and I, 3 businesses and acquired 2. And they were all, like those 2 were small businesses as well, family owned. And there's a couple things that you don't get prepped for. One of them was cash entering your account. And from my perspective, I had this worry about what to do with the cash. And I had not engaged a wealth management specialist. And not until probably 3 or 4 years later, I sat with an account with 7 figures in it for over 2 years and never even put in a high interest savings account. Just silly stuff like this.
Rates were low then. So.
Yeah, they wouldn't have helped very much. But I remember when I did, talk with the wealth advisor, and he kind of showed here you just missed out on tens of thousands of dollars in low interest, and I was like, whoa. So that wasn't it though. It was the tax side of things. We sold one business as an asset sale. We sold another one as 2 of them as a share sale. So with the share sale, we're able to get the capital gains exemption, max out ours, but I didn't think about it for our kids, for instance, or how to structure a business in a manner that would have benefited our 3 children in a more efficient manner from a tax perspective. So there's no question that working with a wealth advisor would have been far more beneficial for us. And so I do have one now, which is great, but probably some missed opportunities there. And there were things like, I went to pay our house off right after the transaction was over, and then talk with our accountant, and she's like, you don't want to do that because you're going to trigger a lot of taxes. I was like, oh. So it was actually less tax to just keep paying the interest rate on the mortgage for a period of time until we could properly put those funds to work for us. But mentally preparing for it was always sort of it'll be nice to win the lottery sort of thing, right? People always think about, well, what if I won $1 million or won the lottery for millions of dollars and then I'd quit my job. Well, entrepreneurs are driven and built differently. There's no way I could quit the job. I don't think it changed lifestyle or behavior very much, to be honest. And you'll always encounter the serial entrepreneur who can't stop doing something again. And to Matt's point, high leverage point. We just have now this ability to recognize and create value and compound it in a risky manner, of course, because it's not just in a small family-owned business. You have your health, and you have your spouse's health. Typically, you have your children's health. Like, that's not a factor that you talk about in your business plan. But if somebody gets sick in your family, your business suffers, and things like that as well. So, we put a lot of time planning and thinking. But probably one of the best pieces of advice that I received was from my first investor, Grant Meadows from Calgary. He had a business. They were doing about $12 million a year at the time of acquisition with 11 employees. Also e-commerce based, so it was quite a profitable little machine. And he ran that for 20 some years, but just near the end, it started to get this hockey stick growth, and so he exited. And then he joined me, and the first thing that he told me to do when we were about a year out from selling, it was just challenges, like like a typical startup. So we'd have our weekly calls, and it was like, this is a problem, that's a problem. And he said, remember when we go to sell, write your list down, because you'll have seller's remorse otherwise. And he said, why are you selling? So I remembered, like, I'm going to pay my house off, max out my kids' RESPs, put some savings away for us, pay off our rental properties, and I'm doing this because I hate this, this, and this, as an example. And then he said, now write it. He was like, very serious. You're writing, in your hand, sign the bottom. Okay, put it in a frame, because 2 or 3 years later after you sell, you're going to say, oh, we should have kept going, or we could have, and you're going to go read that and be like, oh no, I made the right choice.
Yeah, I want to skip ahead a bit. So Julie, I'm curious as sort of what are the unique challenges in terms of like selling to family businesses, or you working with family businesses?
Mm-hmm. Yeah, so I think if someone's selling to a family business, by the time a family business looks at going out and looking at acquisitions, they're usually sophisticated enough, they usually have governance and things like that would put them, almost in the same boat as any other purchaser. So, as we go through a process, if we're lucky enough to take a business to market and have a couple of parties at the table, whether it's a family business or a other type of business, it really doesn't make much difference in how we look at it. But what we would do is we would take a look and say, how are they thinking of the business? What does their process and governance look like in terms of approving a transaction? How are they looking at financing it? Where do we think some of the closing risks are in terms of them versus other buyers? So we wouldn't necessarily treat them differently, but I think we're looking at all of those different risk factors when we look at a buyer that comes to the table. When it comes to selling a family business, there's also lots of different considerations. And, often we'll have groups where there's multiple shareholders. Sometimes they're related, sometimes they're not. And the biggest thing that we recommend is, again, having that conversation early about what selling the business means to each of the shareholders and what makes the right transaction for them. So, for example, even with some businesses, actually, it's a good example. We had a business where there were 2 shareholders. They were related, and one was involved in the business, one was not involved in the business. And so early on, we actually sat down with them and said, why do you want to sell the business right now, and do your interests align? Right? Does one person want to sell? One person maybe doesn't. And so what we ended up doing in that situation was we actually went all the way through with a lawyer and had a pre-sale agreement. So it really laid out, as we go through the process, if we take the business to market and we get a value in this range, both parties are ready to sell, and it's a yes, we're going to move forward. If it comes below that level, maybe between here and here, the relation that was running the business day to day had an appetite to actually buy the business from the silent shareholder, who is a family member. So we actually went through and looked at all that, what makes a successful transaction, and it was documented ahead of time. So much like, putting it on a piece of paper so that you can look back, we went through that process very early on. And I think making sure that you have that alignment of shareholders can just decrease the risk once you have a buyer at the table and help things move a lot smoother.
Yeah. So Matt, how have you sort of connected to sort of the challenges of selling to a family business or being involved?
Well, so again, just from what we've observed over the years, and there's so much wisdom in what Kelso and Julie just shared. Like, the forcing yourself into clear thinking is really important, because the opposite of that is sort of impulsive decision making and hasty processes, and that's when it leads to bad outcomes. So, I think where we've seen family businesses sold to other family businesses, a really important factor there, it's like any sort of acquisition or merger, culture is important, right? So do the two sides like each other? Do they get along? Does this family like that family? Right? That's really, really important, because typically in those kinds of transactions, there's a continuing role for the seller in the future state, and there's a lot of complexity there, right? And people need to like each other, need to respect each other, or it's not going to work. We've seen deals with clients of ours that are done for maximum value and generated enormous proceeds of sale, but the sellers hate the buyers. And it is not an enjoyable experience for anybody for the next couple of years as they work toward earnouts and different aspects of, they sort of live out those deal points that they negotiated ahead of the deal. But there's just a tremendous amount of animosity, and then there's remorse, right? Like there's a degree of remorse, because often that maximum deal, those proceeds of sale, reflected the success of the business ahead of the transaction, which by itself was pretty profound, right? So it just goes back to the wisdom of what Kelso and Julie have already shared, which is it's that idea of clear thinking, writing down like what your real goals are, and getting really, really clear on what that portfolio of options really looks like, and sort of what is plan A, what is plan B, what is plan C, and where do you just say, there's always an option to do nothing.
Excellent. I'm going to go a little bit off script, so I'll give you a couple seconds to think, and whoever wants to answer the question, you can answer first. So what we've talked a little bit about here has been sort of like in the background. I want to bring to the foreground the idea of the emotional journey of all of this. And so we've touched on it a little bit. So I'm really curious about how either you have personally, like Kelso, navigated the emotional journey, or to you two, how have you helped either side of the deal, like navigate the emotional part of this, because it is a family business and it's me in some sense. How did you help that process? So again, I'll let whoever has an answer to go first.
Am I muted? I unmuted to cough earlier, so that was not.
I'd say emotional journey. I think like the UFC boxer Conor McGregor sort of says he lost his mind, when he was going through this whole process, but he said at the end of the day, if my kids are in the house and this is in the house, and he's like, it'll all be worth it. And I don't know the quote exactly, but I felt the sentiment very much, and so probably felt like I was going crazy at some points. And I mean, like you're just doing like things that make you question your sanity in some cases, and like big bets. And at that time when we were there, oil and gas prices, although not the main benchmark for everything that happens in Alberta, but a major driving factor, hit us. And then we're looking at cash runways that are 5 months to depletion of our bank account. Like, holy cow, we got to make some changes here. So a little bit of a roller coaster, but I think for the most part, like just no doubt in my mind that I'm just adamantly crazy about getting this off the ground, and to the point of absolute stubbornness. Like people are like, you should just give up. Like, no, not happening. It's not possible. So there's just this resilience where, the time of the day doesn't matter, and it matters to your staff. So you can't just like call people up. I got an idea at 2 a.m. It's like, I definitely have been there before, and they're like, leave me alone. I don't own this company. But I will just touch base on 2 things to kind of follow up with Matt. I've been on the opposite sides of both spectrums of being hated by the seller where we bought, and also an absolute fantastic family values alignment with the FATH group and this group here. And so I'll just walk through, in a very short period of time. When I met Tom FATH, the numbers mattered, but he asked questions that were so intriguing to me that I could tell that he was testing me in a way, but also making sure that we would align. So like we were out in Cold Lake, Alberta, when I started this company, And so one of the conditions is I would have to move here. One of our other software engineers would move with me. We would close that location. We owned the building, so we put agreements in place for all of that. So he had care sincerely over what are you going to do with these buildings? Is it possible to release these? And it was, and so they sort of paid out some of the leases on them, which was nice. But then he asked a question: when you move to Edmonton, which area of Edmonton are you going to live in? And I said, oh, we're looking at kind of like Wolf Willow Country Club sort of area. How come? I said, well, I like the cedar shakes on the roof. Like, he could tell that we had spent time visualizing what the future was. And then he asked, so what are you going to do after you sell? And I said, I just want to relieve myself of debt and obligations. And at that time, you could imagine what's going through my head, because I have a 3-year-old, a 6-year-old, and a 8-year-old, or whatever their ages were at the time, but a young family, and taking on like more obligation with growth at every step. We had to buy the building behind us across the back alley for more space, which meant more leverage. And so I said, Tom, I just want to be alleviated of all the debt and that responsibility, and do my best work. And so he's like, okay. So in that case, it was, money's going to enter your account on this date, and the day after that, you continue to run it as if it's your own. Just very core values focused, and very little meddling in terms of messing with the process of the entrepreneur. And on the opposite spectrum, we had purchased the BAM sign company, and not naming names in a sense, but there just wasn't an alignment. We came in, we scooped the company up from the entrepreneur who's retiring, who essentially failed to plan to exit, and then got to a point where they're shutting the business in X number of days. So we take an opportunity to acquire the business and then lease the space from that same person. But the alignment created, or a misalignment, a bit of resentment when we tripled the business in the first year, and then it became very profitable. They didn't have social media or a website, and we're building these beautiful like cedar and gold products, and of course it just caught on like no problem. And I could see the value in his customer base. When we finished our 5-year lease inside the space, he also owned the building, the rent tripled. So it wasn't an accident, and it was partially market rates, but it was more so, too bad, I know it's successful, and we'll we're going to stick it to you. And so there just wasn't an alignment, and we pulled out of the space in Banff on that note. Like, we could afford to, and it wasn't necessarily the best choice, but it was just misalignment with the buyer and the seller, and we couldn't get on the same page. Ended up in a lawsuit. Nobody paid anybody. It was all resolved, but don't get to that point.
Mm-hmm. Yeah, I think one thing that people really do underestimate going in is the amount of emotional toll that going through the process like this can take on a business owner. And to Matt's point earlier, involving other advisors throughout is really important. Like, the first time we sit down with a new client, one of the stock questions we have is, who are your accountants, who are your wealth managers, who are your tax guys? Like, we want to make sure that we've got a team built around our clients to help them through the process. I closed a deal with my team this last fall, and it was funny because the day it closed and the money was in the bank, I got the call from the sole shareholder, well, the main shareholder, I should say. And the first thing he said to me was, when you started this job, did you realize that you were going to spend 50% of your time being a psychologist? And, I kind of laughed, because it is true. We work so closely with people throughout that time. You create, lifelong friendships with these people, but you're also, 6 a.m. answering text messages, or it's like midnight, and, it's like, can I just have a quick call? This is going through my head. And a lot of times it's a bit lonely as well, right? Because your staff don't necessarily know you're going through the transaction. Sometimes even your family, doesn't know, the extended family, and the close ones are sick of hearing about it. So you may as well call somebody that, you're paying to be around, and they can be your psychologist. So, I find that interesting. The other point, just to what Matt had said about finding the right party, and, that can kind of help alleviate some of that emotional toll. We're working with a family business right now that's got 100+ years of history, and going through the process, finding the right party is really the number one thing to them. So highest price doesn't matter as much. We've actually accepted a deal this week that was the third highest in terms of value. But as we went through management presentations and we started to get to know the parties that were at the table, we had a very clear vision that we put forward to them. And it was, 5 bubbles that basically said, like, this is what's important to the shareholders. They want to understand that their culture is going to continue on. They want to know that there's a bigger role for some of their staff coming into things, so there was a lot of things that we kind of put out there. And when we got the bids in, we actually looked at all 5 of those little circles and said, like, how do they compare and how would we rank them? So you're right, it's not always the highest dollar value. There's other things to consider as you go forward, but it comes back to, again, understanding those shareholder objectives and what makes a good transaction.
Yeah, and I'll just build on that. Like the one thing that we see sellers struggle with, particularly when right before the deal is closed and then in the immediate time after, is control. So they've been in control up to that point, and then they're literally selling control of the business to another owner, and emotionally that can be a blow. If you've prepared for it, then it's easier to manage. But for everybody, it's a specific moment in time that is probably hard to forget and will always stick with you. And so you need to be at peace with that. The seller needs to be at peace with that and really have a plan. And so control goes back to a point I made earlier too about risk. So, a business owner has compounded value and wealth through starting and running a successful business, taking a lot of risk, but being in control of all the decisions, right? So, and then on the other side of that, they put together a team to help them manage the proceeds of sale and compound their wealth in different ways. They're usually ceding a bit of control across that landscape in order to manage risk differently through the next phase of their life, unless they're getting right back into another business. And that experience can be an emotional journey and require some sort of training of the self before you really take that on. And then there's 2 other things I would say that are important in the journey, particularly for family businesses and smaller companies. There's a lot of care for staff, and there needs to be a lot of care taken with family relationships. If there's new wealth coming into the picture, everybody kind of needs to know what that means for them. And depending on the solution that the exiting business owner has arrived at, there might not be a role in the future for all the company staff, depending on the buyer. And so that's a part of the emotional journey where you got to grapple with that and have those conversations with people and think about the way it affects their lives. So that's really important. Yeah, maybe I'll just stop there. I mean, I think those are kind of the big things, the emotional side.
So I'll go the other way in reverse order, start with you, Matt. So we talked about the emotional journey. What about the role of like legacy and succession planning in this process as well?
So I think that goes back to sort of what Kelso described about, like, why are you doing this, right? Why did you start the business? What's your plan to exit the business? Did you start a business because you want to bring your kids into it? You want to have that next generation come up in that business? Did you start it to sell, to create generational wealth that your family can then try to compound in different ways over time? And so it's, there's an important conversation about legacy along the way. And that's part of, Julia talked about being a psychologist or being a counselor, even in the sort of the transaction advisor role. And it's so true for us too. And I think a lot of it is about expectations, right? Having your expectations calibrated so that, you end up living the dream that you saw. You don't end up living a life that you didn't expect, even though you got an outcome that you had hoped for. And so, part of that is knowing what you're going to do with the money, right? Like you talked about leaving it in the bank for a couple of years. We see clients who are selling businesses, again, for significant proceeds of sale, and then they start spending money on things that are kind of shocking to the people in their family and in ways that they never would have before. So we often counsel clients to have a cooling off period. People are going to be coming at them when there's significant wealth, and that's known, with opportunities, hey, invest in this, hey, invest in that. And it's useful to sort of make public in some way that you're not going to do anything for a period of time. You're just going to kind of have a cooling off period, or you've got specific things you plan to do. But, you know, making sure that, we've talked a lot about alignment this morning, making sure that there's alignment across the people who matter in this landscape on what to expect, what it's going to look like on the other side of it. And so it just feels like everybody's making rational decisions and there's no surprises.
Yeah, I think when it comes to legacy, you know, you really do see the full gamut of things. I think when it's a family business, often legacy is more important than, you know, if it's an entrepreneur that kind of started the business a few years ago and wants to move on to bigger and better things. But that's not always the case. So, you know, sometimes with the family business, you know, we've seen both ends as well, where, you know, it's not so important to me. I got into the family business. It's, you know, third generation, and I actually want to do something different. So the legacy when they sell may not be as important to them. And, you know, in that case, maybe it's a strategic party that is going to pay the highest price. They can take that money and they can do something different with it. And then you see the other side of the spectrum, like the client I'm working with right now, where, you know, he's willing to take a lower price because the legacy in that name continuing on is really important to him. And he wants to make sure that his staff, who are also like family, are treated well and have a place in the new business. So, you know, you see that side, but then you do also see the, you know, I want to do something different, or I don't want to be involved in the business moving forward. So it matters less to me.
Yeah, that makes sense. I always start by writing two conclusions, kind of like choose your own adventure book. And then if you say, you know, well, we wound it up, we sold the assets off at auction, and, you know, we, you know, took the loss and away we went, or, you know, we sold it off and we rode onto the sunset. We write the story in both cases, and then what led to those items. And so kind of working backwards. And I actually always do this, like kind of both of those scenarios. From the succession planning side, I think because I came from a blue collar family, and this would have been, at least from my immediate family's terms, the first taste of wealth, if you will, or something that would last more than my generation and potentially into, when planned right and compounded, as Matt has said, could go into grandchildren. And so that's the goal now. I hadn't really thought about it until almost years after, when, you know, I feel like I should have met you guys a long time ago. would have been good. But working with experts, you know, is certainly important. And then on the other, you know, side of the spectrum, I'm sort of vended into a multi-generational family, where it's a family-owned business. It continues to be a family-owned business. I like the fact that I was still dealing with the single decision maker, like also the entrepreneur on that end. And yeah, succession planning is tough, because it's sort of like writing, you know, writing your speech at your funeral, in a sense. Like, well, you know, what do I want to be remembered by, even when I exit this company? And so, like, we had put together, you know, bursaries or, you know, tuitions for staff, and in some cases helped people pay their houses off, and like certain, you know, key individuals that didn't have ownership in the business. So, you know, there's a lot that goes into it. It's certainly an emotional process, that's for sure. And I think, you know, just some of the great points that both of these speakers here today leaned on: clear goals, like writing those things out, so important. I think I was big on that, and the visualization, like dreaming ahead of what this could be and then documenting it. And I'm not done. Like, I'm very much so doing that now. And then finding, you know, those very trusted people inside of your family or your circle, like a close friend or a close family that truly wants the best for you. And you can have an open conversation, and kind of, I call it bouncing the rubber ball off the wall, where they're not actually giving you any answers. They're literally just repeating back to you what you just said, and so you hear yourself. And I have that in my father-in-law, and he's been there for the last 15 years, helping me always to make, you know, big decisions, and you know, and helping with that planning. So, and again, family member who wants the best for, you know, his immediate family as well. So yeah, anyway, hopefully cover some of it.
Excellent. Yeah. So I'll stop asking questions now, and I'll open up to the floor or to the Zoom world for who may have a question.
And if you have a question, just raise your hand. I'll bring you the mic.
Thanks. Kelso, just picking up on where you left off about your father-in-law, can anyone talk about the role of governance, both inside the family and maybe inside the business, in making a successful selling of a business?
Yeah, that's good. Good question. Well, my father-in-law is a good person to lean on because he worked in banking for his entire career and was doing loan adjudication for large loans, like over 10 million, and so I feel as though he's vetting my ideas for sound business choices. So that was a very important aspect. Like we were recently talking about buying this building or building a new location and leasing, and so like discussing why those would be beneficial to the overall organization. The governance, I think, too, is that I shouldn't, despite the fact that I'll have a CDO title and ultimately have that executive decision, you need to vet and hear from your counsel, and it doesn't need to be a formal organization, a very formal agenda and a meeting, but you certainly need to have a certain core group of people to make sure everybody's on the same page with those decisions. And so I typically think of it as I have sort of like 5 in my council. I have my father-in-law, who I just mentioned. I have my current boss, if you will, who resides out of our corporate office, our CFO. My former business partner who helped me get to this stage today and who is the reason I don't have a mortgage anymore. Like, she's just so helpful from a mentorship standpoint. My wife, who is probably the chairman, and then my son, who's over here vetting ideas. So he's 14, and I'm trying to make good decisions. And the other day, I said, hey, I'm putting a bonus plan in place, and it also includes for myself. I have to go home and I write this out. And he wanted to work out with me. And I said, so would I take this hand to get paid more and put a bonus structure in place, or should I work out? And he said, health comes first. And I said, okay, I won't work on this tonight. I will come downstairs and pump weights with you. And he was my advisor in that case. And he's right, health comes first. It's on my principles list and is ahead of finances, family, fitness, finances, and freedom.
Yeah. To add maybe a little bit to that, if I can as well, whether governance is formal or informal, I think one of the best things that it does is it asks the questions that maybe, the owners aren't thinking of, or, we often see entrepreneurs, they're always, so busy and they're doing a million things and they're running a business, and sometimes they don't take that step back to answer those bigger questions about, what does my business look like 10 years down the road? Who is the best buyer? What's my succession plan? And having some sort of formal or informal governance can often help with that. We've seen terrible situations, to be honest, where, there's a sudden change in situations. The owner dies, and if there isn't some sort of governance set up where they've thought through some of these things, it can put the business into an absolute tailspin. So some of the better scenarios we've seen when that has happened is when there's been a formal governance and somebody's been able to step in and say, okay, we lost the CEO, we can bring somebody up through the ranks, or we go find somebody third party that can come in while we sell the business, but try to maintain some of that value so that it's not lost.
It's someone to talk back in a sense as well, and like identify those blind spots, because their staff won't necessarily tell you you're wrong.
Right.
Yeah.
Just one thing I'll say on that is, Julie mentioned informal versus formal governance. Like, what we've observed is typically in closely held family businesses, what you'd think of as governance is more informal, but it is what it's at its best. It's all stakeholders getting aligned on how decisions are made. And I can think of one example of a family business I know quite well, and there's 3 siblings as the second generation business owners. And so 3 siblings, 2 are in the business, 1 isn't. But their mother and father started the business. It's important to them that all 3 of them, it's not that they benefit equally because one of them is not involved in the business, but there's transparency about how decisions are being made, how assets are being stewarded, and choices that all go out. There's an estate, consideration here that, again, kind of back to legacy planning. So it's sort of informal governance, but it works because everybody's committed on getting clear on how decisions are made. And then as things get bigger and other shareholders come in, non-family shareholders may come in, that's probably where you need to get a little bit more formal about governance. So that, again, it goes back to the idea of no surprises. Right? That's generally a good rule in life, is try not to surprise people.
Fewer surprises.
Yeah.
Now, I used to have a couple of really good friends that ran businesses, and it was always tough because they would say, "You're the business guy," blah, 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 blah. And I would say, is it bounce ideas off of? Is it research? Because I'm not governance. I'm not the brother. I'm not the sister. So don't go take this 2-minute cup of coffee conversation and then go back to your board and say, well, I've talked to an expert. No, you have not. You've talked to a person for a cup of coffee. So it really is getting clear on sort of like where those roles play in governance, because it's easy to sort of run with a half-baked idea from a half-baked friend, and then use that to sort of like be the opposite of actual advice, right? Like my advice would not be the same as their advice, and so I think getting clear on that would be really helpful.
And I'll jump in just on that last point. When going through the ICD program right now with Matt Knight, you realize that there's better decision making in a board when a board's put in place, or at least an advisory committee on a family-owned business, and I can certainly see that. And it's like we're a $100 million a year company with hundreds of employees here in Edmonton in the overall group of companies, but it's still a tire with a spoke in the middle who's the president, and then all of the communications still kind of happen in not silos per se, but there's times where that better decision making unquestionably would be made at a board level.
Excellent. Another question?
Kelso, you touched on this a little bit, but can you speak a little more, maybe Julie as well, the balance that a seller has to have between running the business day to day and then focusing on all the things that have to happen through the sale process, so that you don't end up in your first scenario where you've got a slide in revenues and deal falls apart, and how a business owner can actually manage that without working 28, 30 hours a day?
Want me to start? So I think that's one of the things that people do underestimate when they start a transaction process, is the amount of hours that go into it. And so, part of the value add that, having a transaction advisor like us at the table is, we know the steps, we kind of know what needs to be done and where, and we try and take a lot of that off of the plate of the business owners and entrepreneurs. So very early on, we're planning and saying, okay, we know that 6 months down the road, as we've got a buyer at the table, this is the types of diligence they're going to want to look into. And we have a very intensive period at the beginning where we try and get, all sorts of information from the business. We put together our materials, we put together a diligence room, we get some of that understanding about the business, so that, while we're in the market with the business, the owners can actually concentrate on doing what they do best, which is running a business and keeping it looking good. Kelso talked about it in the one transaction where I think you said you took your eye off the ball a little bit and results started going down, and that can be one of the most detrimental things when you're running a process. As you're going through the diligence period, buyers are very focused, most buyers are very focused on what that next month of financials look like, and are we maintaining the EBITDA that we're paying for the business on? What are things looking like? So they're keeping tabs on that, and to see a decline can just really put pressure on pricing. It can lead to last minute reprices or even a buyer walking away in some instances. So yeah, it is very time intensive, and having somebody be able to take that off their plate, we're able to focus them on the times where we need. So it's the upfront information gathering. Once we've brought parties to the table and kind of narrowed it down to the 6 parties that we think fit their objectives and have put in a bid for the business, then we can focus them on that actual meeting with those buyers, evaluating what the culture looks like, what the fit looks like, and that's where we'll use most of their time. And just having the right advisors for the legal piece as well.
Yeah, so I would also echo exactly what Julie said and remain focused on the business. And I kind of equate it to everybody's got that nicked piece of baseboard or a scratch in your wall or a leaky faucet. and you tend to live with it for years. But when you go to sell your house, you start buttoning everything up. And so aside from just the financials and also trying to run the business, you're also trying to just go around and fix everything else around the business. So make sure everything looks as good as possible. It's extremely time consuming, certainly. I think also, we learned a lesson about engaging some of the team members, the core members, about that due diligence period and when we were triggering into it to stay focused and having milestone completion bonuses. And I think that helped a lot. Like the first time we didn't necessarily have that, but then everybody had something to strive for. But it was also anchored in a certain target and a stretch goal that we would get to. And unquestionably, at least in this deal with 310 Sign, having the additional cash at the end of the bank, the amount that we were going to pay staff out was all made up out of the additional profits that were made near the end of the exit, which was a no-brainer. You'd be happy to pay it because everyone was just striving so hard. Mm-hmm. Mm-hmm. Stay focused on the business.
Another question? Please.
Great.
From a family financial literacy component, as you talked about, Kelso, your son at 14, what does that look like when you groom the family, and how much discussion do you have? And do you include the employees, families, the kids in these financial literacy discussions, and to the whole panel from that point of view?
So I'll start by saying on the families of the businesses, I was talking to Matt over breakfast today and Julie, and we were just discussing how we're having conversations with our staff now about their mortgage renewals and what that might mean for them, and how to create more value inside the company for those employees to earn more in a year or two from now when their mortgage ends up resetting at a higher rate, and that they're not surprised. So it's not necessarily an open discussion where we're planning a session and strategically hosting an information session for our staff, because in some places staff are uncomfortable talking about that. But we're having a new conversation at the table with the rest of our staff about what success means internally. People talk about ESG and environmental and social and good governance, and it's not just about lowering our carbon footprint. It's about the right to retire, like watching out for our staff. So we're putting in group RRSP plans, and there was a gentleman that worked for us for 35 years inside of an organization here, High Signs, and I was asked, so when are you going to retire? It's like, I can't. Ooh. And so immediately that year we put in a new group RRSP plan so that we could start watching out for people. And a year later now, people are opening their accounts shocked to see how much has accumulated in the account. From this side, from myself and my son, we got very entrepreneurial. He started a snowblowing business a few years ago, and we talked about a loan. So the Bank of Dad provides a loan for a new electric snowblower. But when we were putting together, here's your route, here's the maximum, regions that you can go to on your own. So we were discussing those things and then putting a little website together for him. But we looked at what type of model are you going to charge on? So it's going to be a flat fee per month. And let's go back and look at historical snow rates in Edmonton. And so we're seeing how many times might you expect it to snow in the month of December or in November, right out till February. So now he has clients that pay for him for the whole year. So he's got $500 from this guy and $750 from this guy, and he knows his routes. But I remember going through the whole process with him, step by step, line by line, and we worked through a business plan and actually wrote it out. And what are you achieving? What is your value creation? And he's like, people don't have to get out of bed at 6 a.m. and get cold. I'm like, good value proposition right there. Mm-hmm. And so he's still doing that today and doing quite well with it.
And maybe I'll add to that. I think, clearly entrepreneurism, that's what we've seen. What you just described, Kelso, is it's in the DNA, right? You tend to find entrepreneurs in families where their parents were entrepreneurs. And sometimes people break the mold like yourself, Kelso, you talked about that. But then it tends to propagate through the generations. And financial literacy, and either if it's in the next generation, one thing that we focus a lot on in our business is with employees. So we, again, serve a lot of mid-market private companies. And we have a line of business within CWB Wealth called CWB Wealth Wellness at Work. And that's employer financial services. So that's financial counseling, planning, and investment management for the executive team. And the value proposition there is these folks are busy and they tend not to take care of their own financial lives as well as they could if they had more time. And so we come in as trusted experts in that space. But we also provide financial education to employees of those businesses and provide group RSP services. And we find that creates a lot of peace of mind for business owners, knowing that they're taking care of their staff, knowing that they are doing something to create some value for their employees. And it's becoming even more important. Kelso mentioned ESG. So large corporations are thinking about employee financial wellness as part of an overall kind of benefit scheme. And businesses of any size kind of across the spectrum are thinking about that sometimes for different reasons. I mean, for small, medium-sized businesses, it can be for employee retention. It affects performance. When people are under financial strain, there's probably nothing more stressful in life than when you feel like you're not going to make it financially. And so, when an employer can step up and contribute to more peace of mind there, it can actually kind of help the performance of that person in their job, and that goes straight to the performance of the business. So it's for us, it is part of our kind of wealth advisory experience with client families and with the businesses that we serve. We think it's really important, really proud of the work that we do there, and we see the value of it for the folks that we do it for.
Mm-hmm. Yeah, I love what you said as well about, entrepreneurs breed entrepreneurs. And I think that's, partly because they get the opportunity a lot of times, or what we see anyways, is they get the opportunity to be at the table earlier and to learn from, family members that are going through things and experience things earlier on. So we do see a lot of that where it's, maybe not the same type of business, maybe it's not taking over the family's business, but where, entrepreneurism breeds entrepreneurism, and that next generation has a kind of a leg up in terms of, business acumen and kind of understanding where issues can be.
I was going to say, I hope it snows soon, but I guess your pricing model, it doesn't matter.
Probably better.
Anyways, that's good.
It's getting paid regardless for November.
If I could add one more sentence to your specific question, I would think through financial literacy like technical literacy. So a lot of owners have their kids learn the business, like the technical parts of the business, but not the financial part of the business, that the owner then sort of learned through sweat and tears. And again, I've had too many phone calls from, son, daughter, son-in-law, daughter-in-law, because dad, mom hasn't quite talked to him about the actual financial part, because dad, mom is staying dad and mom. And so you know how to do the XYZ, but let's not talk about the money. And hey, Marvin, what do you think? Well, again, I'm not the advisor, so go get real help. But that's something you should know, because you're going to inherit the business that's going to be 20 million, not build the business from 0 to 20 million. Mm-hmm. Those are two different financial ways to run the business. So yeah. Another question? Do we have one from Zoom? If not, we'll have another question in the audience.
No. We got one last question, and then we'll maybe start with Kelso and work our way back on kind of advice for anyone selling a business, and then we'll get Marvin to do a quick wrap up.
Thank you. In your experience, what are the key considerations for a family business when choosing between selling a business and potentially winding down a business?
Yeah, I can start on that one. So I think, when we first meet with a business owner, one of the first things we do, and I talked about it earlier on, is just understand what the value of a business is. So I won't get into technical business valuation points, but to look and understand what the financials of the business look like, what the market is for that type of business. So are there, transactions happening? Are there buyers that are looking for businesses in that institute or in that that area? And then, from the technical business valuation, is it something where there's goodwill in the business? And if there's goodwill in the business and the business is making money, typically the answer is that it's better to sell the business than wind down. But there will be cases where, you know, a business is extra asset intensive, or it's just not an industry where a lot of people are buying, where it does actually make sense to look at what the value is on a wind down basis. So yeah, it's a bit of an exercise usually at the beginning, just understanding what the profile of the business is.
I've found where businesses are winding down, where we've acquired one in this actually two in this fashion from retirees, it's that there's such a technical expertise requirement for that person to step in the role that it's so daunting that aside from knowing how to run a business and cash flow management and, you know, all the financial acumen that's required, you need this like high level of expertise that the business owner currently has that he or she have never put onto like a standard operating procedure, which of course is like a very unfamiliar territory. Like, why would I write all this down or pass this knowledge off? And so then you get into a wind down scenario where they just can't find an applicable suitor. To me, winding down a business is never an option. Like, it has just never really crossed my mind. But, you know, seeing them, it's not necessarily a sad thing to see, but like you're hoping someone's going to take over this legacy. The business has been around often for decades and you want the name to live on. And in some cases, I think that's where a new generation has an opportunity to take over a series of businesses from baby boomers who hadn't planned to divest. And so our whole business model is kind of planning for that there will be a lot of companies exiting in this space where we'll be, you know, helpful to take something over from them, helping, you know, write those procedures or getting some of the knowledge in a relatively short period of time. That's where I'm headed this afternoon, in fact, is to go through and look at a business that has been a discussion over the last 10 years. And then I finally got the notice that on December 22nd, just before Christmas, this business is closing. So I phoned him and I said, let's not do this. Let's find a happy path here where your business lives on. But now we're talking at a fraction of the price. And so it just all comes back to that planning and, you know, meeting with the advisors early, especially when business is doing well, is what I tend to find is near the last few years that the sales tapered off and things like this. But it's usually a reflection of health conditions or, you know, just not having the energy to keep the business up, because entrepreneurism is a high energy game. Like, and over the time period, you know, we just start to see a little bit of decline near the end of the business. So try to plan to divest, and what this whole topic is about, the timelines in selling before you get to a point to wind down.
Yeah, I'll just add one thing to that. What we've seen, I'll tell you a story about a business we know well, and they had this exact deliberation you're talking about, where it was an asset-intensive business, so there's a mathematical game to play there. Like, we could just sell the inventory, and would that create more proceeds of sale than selling it as a business? And ultimately, they decided to wind down the business, sell the inventory, and that was a value-creating choice for them. But the other choice on the table was keep operating the business and actually scale it up, go out and start new locations or acquire other players in the space, which they had the financial wherewithal to do, but they didn't have the passion for it. Yeah. Right? They did not have the passion for that business anymore, and so that option was more or less off the table. They took it off the table themselves, right? And so now they're re-energized by, you know, what they have now is a holding company with assets that are that look different than what they had before, but it creates a different runway for them to do entirely different things that they're more excited about, more energized by. Still entrepreneurial ventures, just in a space that they're more excited to be in. So that's part of what we've seen in some of these deliberations between sell, wind down, or scale up.
So last 30 seconds, advice, a key message.
You should actually ask more questions of the acquirer, which is something that we didn't do. And so I think that was a very important part that I missed out on. Like, how stable is this company I'm coming into? Those kind of questions. That was very important. And I was coming into a business that was acquiring us for a reason. I didn't ask why that was, and it was to ramp up stagnant sales, but remove a poor culture as well that I was coming into. That was a shock.
Yeah, I think my biggest piece of advice would just be to, plan early and understand, again, what makes the right outcome for you. So without knowing that, going into a process blind, I think there's a lot of risks that pop up. There's a lot of, something gets closed and maybe it's not the right deal or it wasn't the right move for shareholders, employees, et cetera. So it's just, take the time to plan up front, understand what's important, and then surround yourself with the people that can help you do it.
Yeah, just build on that very last point. Plan ahead, which I've said many times this morning, but also focus on coordinating your team of advisors, trusted advisors around you, so everybody knows their role. Everybody has a clear mission to play, and there's no role. There is role clarity, right, across your team. You've got your employees that are in the business. You've got your team of advisors you build around you, and you really need to be purposeful about coordinating all their activity and making sure they're functioning as an effective team around you.
Well, excellent. So let me say first, thanks to the three panelists for being here today. I heard some really good messages. I think you all got them as well. The one that sort of stuck with me was the idea of living a dream you saw, which really then means you have to then have a dream, have a plan. So what's your plan for this, and then work backwards from there so that it's a celebratory moment, not a moment of stress and frustration and unhappiness in some sense. And I thought that was a really good way to sort of discuss our three panelists. I also want to thank sort of the sponsor, or will you do the final thank yous? Okay, I also want to thank our sponsor today for the event as well today, CWB. That's actually really good for that. And then thank you all for coming to breakfast for us. And we look forward to having you up in other events. And with that, I'd like to end early. You have 3 minutes back in your day. See you all later.
Thank you.
Thank you.